game actually has any effect on prices. I mean, at the end of the day, the only caution thing I would say about this market, and as it was mentioned before, we are also big in the States and in Europe. Canada is a resource-based economy, and let's all remember that. And as long as resources are doing fairly well, I think the market here is going to be great. If there is a bit of a caution, is resources and resource prices is not predictable. So I would say this is one factor that could have a bit of an effect. On a relative basis, all things being equal, there's no question that Toronto is not expensive, and Canada, by and large, is not expensive. If you take it, most of the buyers in, let's say, in the downtown area, which is financial professionals, and trust me, I think there is too many of them. We don't need that many financial professionals. But assuming we do, their affordability on buying condos in Toronto is better than in New York, Chicago, San Francisco, London, many other cities in Europe. So I think your real risk today is macroeconomics, which really nobody can predict. At least I don't feel that we can. So as I said, I think that if you're a private investor in real estate, I wouldn't speculate on real estate. Nothing is very cheap right now. You know that because you see how many cranes are around, and you see how many companies are going public and selling stocks. So generally speaking, the market is not cheap. However, there are people who's been in this business for a very long time and are well capitalized and will fare better even in a downturn and will continue to make money in this business because the business model simply works. I think that if you look at the big bankruptcies in real estate or the big fail-out in real estate, whether it was the subprime now or the 80s here, the ONY properties, or there were other large Canadian developers who went down, it's because of two things: over-leverage or conflict of interest. When the guy that is investing your money doesn't have the same position in the equity as you are, and he's not aligned. He's there for a fee. He's making money because you're buying, not because you're making money. So that's what I was worried about. Other than that.
Okay.
Yeah, this is to Dori. So I'm a real estate agent. I have a 150,000 square foot shopping center for sale. And okay, so my question is, should I sell it now or shall I wait if it's a compression in rates? And do you see cap rates coming down?
Well, if it's well located and it's well priced, you should sell it now, right now, to us. But I think shopping center is a very good product, and if you're able to manage it well and to service your tenants well, and if tomorrow you need more capital into the property because you're not fully leveraged, and one of your tenants goes bankrupt or wants to expand, or you need to do certain things to keep up the shopping center with the current design and style and competitive environment, I think shopping centers is a good industry, is a good asset class to be in. And if for anything else, this is one of the asset class within urban markets that you get the most amount of land for your money. And land is what appreciates in value, right? Building is a depreciating asset. Land is an appreciating asset. The one thing that could interfere with this theory is if you're in a trade area that has too much retail and you're going to lose tenants and you're not either patient or capitalized enough to withstand a long period of vacancy or downturn. So again, there's no one answer fits all, but I think shopping centers is a good business. Or you can take a 50% partner, objectively, such as First Capital, to manage it for you.
Hi, my name's Lauren Persico. I'm a former undergrad from U of T. Never got into the MBA program here. I had to go to York University for that degree. Anyways, have a question about the condo market. There seems to be a lot of 50-story towers being approved in Toronto over the last year. I would like Garnet and any of your opinion about there's a lot of potential projects coming up over the next few years, and how the market, or your belief that the market can absorb these type of projects. It's not like and there's intensification of the main streets and so forth in Toronto, and therefore there seems to be a potential for a lot of supply.
We're building a few of those. And it's a part of the official plan of the City of Toronto to actually encourage in certain areas along Yonge Street corridor near subway stops, various areas where intensification is a desirable thing. And so there is a bit of encouragement for that to take place. This year we're going to sell in the city, I think it's somewhere around 23,000 condominiums what we sold in this city this year. Our infrastructure is probably capable of building 20,000, the construction trade infrastructure. So there are going to be 3,000 more sold in a given year you would be able to build, but of course the sales numbers go up and down. The demand for the condominiums, demand for housing in the City of Toronto runs around 40,000 units a year, rising each year because we have 100,000 people a year arriving in this city. And the single-family housing market is disappearing. If you want to buy a house now, you have to go up to Nobleton and the outlying areas where we actually build houses, and it's getting very, very expensive. In short, we can't build them fast enough to satisfy the demand unless something happens. And the intensification is really not hurting the market at all. It's actually helping satisfy the demand. If we can't supply that demand, people are going to go elsewhere, and we certainly want to keep that population moving into Toronto.
Will, if I could just comment on that question. I was just at the recent CMHC Housing Outlook conference, and they had Chris Hume, who writes in the Star about rates, condo buildings, and his comments were, height is not the problem, it's what you do at street level to create sort of the environment. So for many of you who realize, one of the major redevelopments was Minto at Yonge and Eglinton, and everyone fought like crazy and said, you can't put 52-story condo at Yonge and Eglinton. Well, that's where it should be, right at a major access of public transportation, lots of shopping, lots of amenities. And when you go to that project, for any of you who've seen it, you don't really realize it's on a 5 or 8 story pod with the 52-story building kind of hidden away. And you know, his comments were, and it was kind of interesting, it's you know, you go to Hong Kong, there's 88-story condos, and it's not really the height that's the concern, although all the NIMBY and sort of neighborhood ratepayers are fighting like crazy. It's what you do at street level to create sort of that Main Street, you know, work-live circumstance for the community. And I think the politicians are going to have to realize, like, let's not get so fussed about 50 or 55 or, I mean, the new project at Yonge and Bloor is going to be 65 stories, but I think it's what they're doing at street level with retail and commercial that is going to make a difference, and kind of the 65 feet above that is going to be somewhat hidden and immaterial to the overall intensification of those kinds of sites.
One question I had, the three speakers, about the projected inflation and how would that impact the future real estate valuations? Because 2012-13 is going to have some inflationary factors.
Didn't have immigration, I think certainly Stephen and I would be wrong. It wouldn't be a great situation. That's the big driver of economic growth in this city, is immigration. Not just from without the country, but also within Canada. We tend to get migration here from other parts of the country. But we get up to 100,000 people a year coming in here, and if we took that demand away, then we'd have totally household formation, which takes place naturally in an economy, and we wouldn't get that drive. We're the largest housing market in North America right now. The only one that really competes with is Houston. From time to time, they're a little bit bigger, and we're a little bigger. Condominium market, we're double the size of New York City, and we're by far and away the biggest condominium market in North America. That's because of immigration. You take that away, well, I'll be going back to single-family lots.
Question at the back. Yep.
Thank you. Good evening. My name is Irene Gorin, and I'm a guest of one of the graduates. And I'm a resident of 905, moving to 416 shortly. So my question is 416 versus 905. Do all those trends about Toronto also apply to 905, or is that different? As well as, is it still exodus to the suburbs, or mostly people coming back to Toronto? And by the way, I have a beautiful house for sale in Oakville for anybody who's interested. Thank you.
Yeah, probably I can deal with that because I deal with it every day. It's much more expensive to develop in 905. If we go to Halton region, or perhaps most of the municipalities, we're dealing with something like a $40,000 a unit development charge, plus all the other lay-ons and so on. By the time that we get around to providing a house with land transfer tax and HST and so on, we're starting to approach $100,000 on any house or condominium that we built out in that territory. Here in Toronto, we have a development charge of around $10,000. It was until recently $4,000. I don't think Toronto is developing any more infrastructure, particularly downtown, so that's just really a taxation that goes into the general coffers, even though the Planning Act provides that all of the development charges that are raised in this manner should go into infrastructure or various other elements that service the real estate community. That's really not happening. But if I'm paying $70,000, say, per build, or $70 per buildable foot for a housing unit in downtown Toronto, and paying $10,000 for a development charge, you can see that when I go to a community where I have to pay $40,000, there's much less land value left. But the other problem I have with the 905 area is that I can't sell the condominium for nearly the price there. I might get an average of $650 a foot here. Maybe I get $550 a foot there, and I can't make any money. And that's, now eventually it will go to 905, but my experience with the real estate industry is perhaps not the right way to describe it, but it's the way I describe it, is it builds from the inside out and it dies from the outside in. So if we are heading into a bubble, I definitely don't want to be in the outskirts. I want to be right downtown where I know I'm going to preserve my value. So it's very difficult for me to buy on a hold basis in the 905 area.
So we have our last two questions lined up, one at the back and then one up the front. Okay?
Hi, my name is Vanessa Oliver. I'm not a U of T grad, but I do work in commercial real estate. I've got my own brokerage company that focuses on retail leasing. My longer-term aspirations, though, are to be a real estate owner and not just leasing the space. And you may have answered my question a little bit, Garnet, because it relates to beyond the 905. I've started investing in student housing in secondary markets. It's more affordable. I can't afford Toronto investment or student housing. And what I've seen, you know, my condo in the last 8 years has almost tripled in value, whereas some of these student houses in Guelph have barely increased, you know, by probably not more than 20%. But the return on my rental returns are very, very good and much better than I'd get in Toronto. And I'm just wondering, with this issue of affordability in Toronto, with what you were talking about, Stephen, with young people with good jobs just not able to afford 416 living and maybe even 905 living, if you think the trend in increases in values of, houses in some of the outskirt, maybe 519, if we'll see a trickle of that with, you know, not a lot of rental properties in Toronto, will people start to say, we want to own, and we'll start to buy, and will those prices start to come up?
Who's answering that one?
Well, let me attempt to answer that. You've got smaller demand for Guelph for some of these centers. So I think, you know, your prices, you know, one of the primary drivers is going to be demand. And sure, You've got, you know, I can tell an interesting story. We have one of our clients is an investor with a standalone shop.